and welcome to the UTI Mutual Fund Swatantra series powered by ET Now. Happy Independence Day to you and your families. I hope you're enjoying your long weekend. It's also a time for us to focus on our financial freedom. Can investing smartly and managing our money smartly give us the kind of freedom that we need and we hope to have when it comes to our money? That's what we are focusing on this week on the show. I have an audience in the studio with me, and to answer the questions that our audience asks, we have two wonderful guests. Govind Narayan is the founder and managing director at Clairvoyant Capital. And Surajit Mishra is the executive vice president and national head of mutual funds at Wwatch Capital. Gentlemen, thank you so much for coming in.
Thank you.
I want to focus on this concept of financial freedom. Let's start with you, Govind. When you say financial freedom through investments, what are the three things that come to mind for you as someone who gives advice? What are the three things that we should always keep in mind?
See, financial freedom might mean different things to different people. Surely what it is not having lots of money. Having lots of money doesn't mean that you are financially free, because that money, we have heard stories where people have had tons of money and they have become bankrupt over a period of time. So what financial independence means is ability to have a particular standard of living on a continuous basis without fretting for day to day struggles in terms of finances. So whatever we want, whatever goals we have, we are able to achieve those goals. So it's about drawing a financial plan wherein we define our goals, various objectives at various points of time, and plan it in such a manner that we achieve all those goals. That is what financial freedom means to me.
Well, Surajit, if I were an investor who came up to you today and said I wanted to invest my money without having, say, health insurance or life insurance, if any of those other things that could take care of emergencies, would it be possible for me to achieve financial freedom?
Yes, of course. First of all, I would congratulate the entire nation on the Independence Day. And let me tell you that my understanding of financial freedom is simply that your income should be always ahead of your expenses. Now, if you want to achieve that, you have to plan your money in such a way that every month you save something during your earning career and you earn something or get something back when you are having a retired life. If on the way, if you have achieved your financial goals, then you are a financially planned person. It doesn't matter how much of money you have got, but if you have got money when the time of need, then you are financially planned.
Well, a lot of times people will assume that, if you ask someone, even a very young person, what they want out of their finances, they say, I want to retire really early, maybe by the age of 40 or 45. But if I were to read into that slightly closely, it's not so much that they want to retire and do nothing, but I want to be able to achieve a certain amount of freedom where I can do what I want without having to worry about earning money. Or I don't want to have to take a job simply because I need the money. I want to be able to do whatever makes me happy. If I'm one of those people, I want advice from both of you, and we'll start with Surajit. What should I be keeping in mind now when I work to make sure that I will reach an area when I'm 40 where I don't have to worry about money anymore?
First is clear definition of your goal. One is aspiring for something and the other one is planning for something. I would suggest to plan for something rather than just aspire. Because if you are very clear that you want to start something on your own or you want to go on independence after 40 or something, then you have to plan really early. Because 25 to 40 are the formative years when you earn little, and if you plan your savings perfectly, well, you can build up a corpus, you can have a regular income equivalent to your salary coming out of your savings, and if you achieve that, then after, of course, you can do one thing where you can take some risk, create a startup. Today's fad is startup, so you can do a startup or something, or you go on some independent lifestyle. For that you need to plan very well, and you have to be very, very religious in terms of following that goal. It is doable. The beauty of India today is that youngsters are earning much more. If you look at the generation prior to us, everybody was planning for their house only after retirement. When they used to get their PF money, they used to plan for their house. But today that's not the case. A guy who joins fresh out of college, he plans to buy a car, and after 3 years into job, he wants to buy a house, because you got home loans and all. So with that thought, if you are planning, then of course you can plan for your retirement after 15 years. So 40 is not a bad age.
Govind, how can I use mutual funds to make those plans?
See, mutual funds are such easy instruments to get into, in the sense that You can start with as small as an amount as 500 rupees and start investing. And what mutual fund does is, if you particularly take the SIP route, the systematic investment plan route, it brings in a lot of discipline. And what it also helps in terms of achieving your goal is also the power of compounding. Now what happens is that you initially, the goal that you plan might turn out to be very humongous, you might just get bogged down. But even if you slightly start contributing a little more over a period of time, not begin very big but small, even if you start early and then keep on growing up. Now what will happen is, because of the power of compounding, we will be able to easily achieve our goals. Now let's talk about India. We took 50 odd years, 55 odd years to reach our first $1 trillion. The next trillion came in 7 years. We are almost a $2 trillion economy. The next trillion will come in only 4 years. So what we are talking about is that the compounding effect is so much beneficial, is that it helps you achieve your goal, whatever target you have. You start small, even in a mutual fund, even with a small SIP. If you begin, you just need to ensure that your expenses don't exceed your income. So the moment you do that and you set aside some money on a regular basis, continuous basis, you will be definitely able to achieve your goals over a period of time. And also you need to monitor your progress from time to time. It just can't be one point to another. So you might need in terms some kind of help in terms of aid, advisory or whatever, but you need someone to really see whether you are going on the right path or not, and you have to be just persistent. That's it.
All right, so the first thing to do is to make sure that you have enough savings from your regular income, and put aside whatever little you can. You have to start putting aside today. It's time for us to take a very quick break. When we come back, we'll be answering more questions from our audience. If you have a question at home, tweet out that question, #Swatantra. It'll be our pleasure to hear from you. Don't go anywhere. Welcome back. You're watching the UTI Mutual Fund Swatantra series powered by ET Now. Thank you so much for staying with us. This Independence Day, we're talking about financial freedom and how you can achieve it using mutual funds. We have questions from our audience members, so we're going to get straight to it. Yes, sir, go ahead.
What is the right age, according to you, to think of financial freedom? When you earn money or when you are planning investment?
I think any age is right age, except for the student age. Because I'll tell you, financial freedom is nothing but sacrificing something today to have a better tomorrow. So it's better to plan early rather than late, but at any age, financial freedom is all about having income higher than expenses.
Actually, I want to very quickly ask you, why not students? Why don't you want students to consider their investments?
No, students should consider out of their pocket money. That's the limited ability that they've got, unless until you are born into an industrialist family.
Govind, you want to add something?
Yeah, I mean, as Surjit said, any age is the right age, but as they say, jab jago tab savera. So whenever you realize that you got to plan your finances, you should start from that day itself. In fact, today is the day. The time is now. It's always like that.
In fact, the financial freedom definition or the goals keeps on changing as your earning power goes up. Okay. So is it okay, or somewhere we have to stop and there will be only aspirations left?
Actually, that's an interesting question. The fact that as I get older, my lifestyle changes, my family's expectations change. It's a moving goalpost in terms of what I want to retire with, how much money I should technically have in the bank. So how do you basically modify your financial plan constantly as you go forward to make sure you can still achieve those goals?
There are two core concepts that you have to consider. One is a demon called inflation. You need to figure out your petrol was 16 rupees when you were in college and today it is 75 rupees. If you don't figure out, you can't run your car. So that inflation part has to be taken care of. The second is you have to give some earning growth to yourself, whatever age you are starting. So even if you are starting at the age of 55, 60, If you are planning to, typically the life expectancy has gone up and some average life is now 78 years. So for 20 years, your expenses will not be consistent or same. You have to have a provision for increasing your expenses, but natural that will happen. So your income level has to go up. So if you look at that, and somebody who's at a younger age planning, he has to factor in both these things. Even at a later age also, this planning has to be such where the income has to continuously grow. So with that thought, you need to factor in that your goalpost will move because of two reasons. One, your personal aspiration. The other one is whether you aspire or not, inflation will eat into it.
Govind?
Yeah, I mean, just to add to what Surjit said, now, for example, if your monthly expense today is 25,000 rupees per month, now that figure, because of inflation, will become 125,000 rupees maybe 25 years from now. So to generate 125,000 for a youngster who is 35, 125,000 rupees, if he wants to generate month on month, he'll need to have a corpus of 1.5 to 2 crores. But that figure again, if the longevity is 85, that will be 6,25,000 rupees. So you need to have much more. You cannot consume whatever you are earning. Even after, at the time of when you leave your work, you will still have to have a corpus which is more than what you are consuming. So you need to earn more on a continuous basis, either through active work or through sedentary work in terms of investment. Your investments will do that much more. So we need to have earnings which are definitely more than our expenses.
So how much percentage of our salary we should invest, minimum percentage of salary we should invest for our retirement benefits?
It will depend on your specific situation. Now, what is your income and what are your expenses? There are some expenses you can forego at this point of time which are not necessary. Okay, there are some expenses which are absolutely necessary, you can't forego. So depending on your situation, you will have to set aside whatever best you can. I am not saying that you don't live for today. I mean, you have to make some expenses for today also. You need to have some lifestyle benefits, enjoyments as well. But still you need to have enough money to save to ensure that your aspirations are met all through your life. It's not just for today, it's for all your life.
And just supplement
Sure.
with just 2 lines. You should start with at least 15% of your net income. That's the bare minimum, because fortunately in India we have got something called Provident Fund, which gets deducted willingly, unwillingly. So that takes care of your retirement needs to a certain extent. And you are fortunate to have 8.5% return in that. Other countries, they provide 1 or 2% only and government securities. So that's one. 15% is something, and as you grow in age, you will increase that percentage. Because your expenses remain relatively less and earnings go up. So your savings habit will help you increase that limit.
But sometimes in the market we see in retirement, suppose we consider as a year or 20 years.
Right.
Sometimes for 5 years some mid-cap stocks running. For next 5 years large-cap stocks running. Right. For next 5 years diversified stocks running. Right. How to select that scheme for the retirement benefits?
Right. See, basically it will depend on your risk appetite. Now, basically when we talk about large cap schemes, they are less volatile compared to the mid cap schemes. Okay, of course everything is volatile. When you are investing in equity, you need to really plan it for a long term, because normally when we talk about equity, we talk about 5 years is long term, 7 years is long term. Actually equity is long term 25 years from now or 20 years from now. Now when we talk about our index, we started at 100. Right. Today we have multiplied 270, 280 times in a matter of 30-35 years. So that one thing that it's not, you need to be agnostic in terms of what large cap, mid cap, or you just need to invest in a good fund, select a good fund, which is preferably a multi cap fund if you are a beginner, and then continue investing for a long period of time. You will definitely get your rewards in terms of your returns. See, it is the asset class which is important. Now, for example, even if you are not in the best fund, in a mutual fund, you will still make more money than your FDs or your debt instruments. So just start investing. Which fund is really not too important? I mean, of course it is important. You need to, there are websites where you can go and access the information, which funds are doing well, which funds have been consistent over a period of time. So you need to value consistency more than immediate returns. Now, for example, someone giving 50% return this year doesn't mean that it's a good fund. Right. So you need to have other parameters as well. So based on that, there are websites, there is information, you can have access to advisors they can help you choose a fund and then start the investment.
All right, it's time for us to take another very quick break, but when we come back, we'll answer more questions. Don't go anywhere. Welcome back. You're watching the UTI Mutual Fund Swatantra series powered by ET Now. Thank you so much for staying with us. We have time for a couple of more questions from our audience members before we wrap up the show. You had a question. Go ahead.
We always hear that mutual funds are subject to market risk. What market risk are we talking about?
This is an excellent question, and I know there are a lot of people at home who are also constantly wondering this, because more than anything else we know as audience members about mutual fund, we keep hearing that they're subject to market risk. What does the market risk mean?
I'm very happy that you raised this question. Mutual funds are subject to market risk is the tagline of mutual funds actually, but that's very carefully done. If you see the history of mutual funds in India, it has gone through a very good evolution phase. We had some great schemes starting with great names like US 64 and all, and then after towards about 2000 they were going for some challenges. Now what is happening is people are not understanding that there is something which is getting invested in the market, and if you are investing in the market, be it equity or debt, there are some inherent risks of any investment. Now this inherent risk has to be told. If you go on the road, the safety belt is a must in the car. That is also subject to market risk or road risk. So in mutual funds what they are trying to explain is, please, the second line if you read further to that is, please read carefully the offer document before investing. So it has to be seen in conjunction. The second part says that what you are getting into, you should know about it. There are products within mutual fund, although many a times normal investor believes that mutual fund is synonymous to equity, it is not so. Mutual fund has got a variety of investment. There are products which are safer than bank deposit also. There are products which are competitive to bank deposit and gives little better return, more tax efficient return, and there are products which are investing in equities which carries little higher risk. So according to your need you should invest, and mutual fund is a basket of products. You have to select what product category you want to get into. If you are going for a product which is safer than bank deposit, which is called liquid fund, your returns will be 7 to 8% in the current circumstances, and your capital is absolutely safe. Whereas in equity, your returns can be as high as 20%, but your capital can be at risk. That's why for the time period for investment is very important. The risk factor gets diminished as you invest for longer. If you are investing for 3 months, then equity is not at all the product. But if you are investing for more than 3 years, probably 5 years, 6 years, equity is the best product to invest. So it is more linked to your own goal rather than the underlying the tagline or something.
Yeah, to add to that, the fact that we say that mutual funds are subject to market risk, that gives us an advantage also. Probably most people ignore that advantage. The advantage is the tax efficiency. Because of this being subject to market risk, if for example the bond funds of a mutual fund, which is a debt fund which normally gives stable returns, were not subject to market risk, it would have been taxed like an FD. Now if you hold on for a period of say 3 years, a mutual fund product, a debt product, it is subject to long term capital gain, so which can be indexed, and the tax could be as negligible as 0 also at times depending on the inflation. So subject to market risk, of course the market risk is that the underlying asset which you buy indirectly can come down. While it goes up, it can come down temporarily or for a longer period of time also. That is the risk that you need to be aware of, and which is very crucial for you to take the right investment decision with the right kind of time horizon.
If we see the performance of mutual funds for last 10 or 15 years, it has been 15 to 30% we can say. Do you think it will continue in the future, especially if you consider this economy?
Actually, that's a fair question, because when you talk about market risks, one of the things that you should remember with market risks is, like the young lady rightly pointed out, that past performance is not an indicator of future performance. Correct. There's no guarantee that what has happened in the last few years will continue. So then how do we know what to expect when we're getting into a mutual fund?
See, what happens is that the question is very appropriate, whether the past will be, you know, replicated in the future. Now, one needs to understand one thing clearly, that our economy is growing. And now also, if you see last 7 years, the index has grown by only 4-5% per annum compounding. We were at 21,000 in 2007, 2008, 7.5 years from now, we are at 28,000. The growth is only 4.5% compounding. But if you see mutual fund portfolios during this period, they would have given returns which have exceeded 15-16% also. So there are what we call the alpha managers in mutual funds who really generate that alpha for you. They do the research and bring the goodies to you. The returns have been really good. We have been able to, as mutual funds have been able to, you know, beat benchmarks on a continuous basis. So you can expect good performance over long periods of time for sure. Even, you know, the only thing is that whenever we talk about equity, don't look at very short term, because you might just get disillusioned and you might exit. There have been people who have been holding on to mutual fund from 2007 to 2013 and they exited at the wrong time. So you just need to be consistent in terms of your asset allocation. Just be there and wait patiently, you will get your rewards.
What do you normally say to a client who comes into your office saying that, you know, I know you're telling me to invest in mutual fund, but I'm very worried about the risk. I'm very worried about the market going forward. What if the economy crashes? I've heard this, I've heard that. What is your response to someone like that?
My first question is, for how long you are investing? How long you want to invest for?
15, yeah, different in mutual funds for different, so 10, 15, 25.
Yeah, if you are looking for 10 years, 7 years, 5 years, you need not worry. If I can be allowed for an elaborate answer, let's look at last 15 years in India. Market has gone from 3,000 to 28,000, which works out to be a 19% compounded annual growth rate. So if you are investing for 1 year, any of this period, for example, he mentioned 2007 December, market is 21,000. You invested at that point of time and hold it for just 8 months time, market was at 8,000. You would have lost 50% of your money. But if you would have invested 1,000 rupees every month starting 1999 to 2015, you would have earned probably 1,000 rupees would have grown to what? About 1,80,000 investment, but it would have grown to about 18 lakh rupees or so. So this is the power of compounding that we are talking about. If you are investing lump sum at the wrong time, looking at others, looking at your neighbor and coming to the market, please don't do. If you are very clear about your goal for 7 years, 10 years, 15 years, start an SIP. You are a young lady, you can start your SIP now, leave it for 10 years. Look at the power of compounding that helps you.
I'm investing in mutual funds on your instruction, my life savings for my retirement. But here is a product that is impacted by things that are happening halfway across the world, which I have no control over.
Absolutely.
So as an investor, obviously I am going to on some level get very, nervous about everything that happens across the world. So how do I put that into perspective with my own retirement plan?
Yeah, we need to look at 3-4 things. If you are investing in India, what is the inflation? We have to beat our inflation, right? If our inflation is 7%, what is our GDP growth? It's about 6 to 7%, sometimes it goes up to 8%. Typical equity market behaves as a combination of these two. Over a longer period of time, the GDP growth rate, nominal GDP growth rate, which is a combination of GDP growth rate declared by the government and inflation, the addition of the two. Equity market growth reflects these two. If you look at a 15-17 year history of any country in the world, which has got a good thriving capital market, they reflect this number. So if I have to need money, I need to grow that money at 12-13%, which will provide me 5-6% return above my inflation, above the country's inflation. If that is the return that I am getting, I am planned for this. Short term, you will have these problems. We had as many number of problems in the past, we will have as many number of problems in the future also.
So alright, so asset allocation is the absolute key. It is important to use equity mutual funds if you're looking at the future, and planning carefully for your investments and investing as little as you can, but investing every month will make sure that you get yourself some financial freedom. Gentlemen, thank you so much for joining us and answering our questions. You've been a wonderful audience. Thank you for joining us as well. If you're watching at home, you can obviously log on to our website. It's called indiainvestkaro.com. Leave us a question. Or on Twitter, you can tweet out your question, #Swatantra. Thank you for watching.
to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.